listening to Let's Get Surety. Let me hear your bonding talk with Kat Shamapande.
Hey everyone, it's Kat Shamapande. Welcome to this episode of Let's Get Surety. Today I have with me as co-host Mark McCallum, CEO of NASBP. Hey Mark, thanks for being on.
Hi Kat, always a pleasure to be back.
I'm excited about today's topic. We're going to be taking a look at the economic outlook for the construction industry throughout the rest of this year and moving in throughout 2023. It's an exciting topic. And to do that, we have with us construction financial accounting expert Todd Feuerman, Director and Chair of Construction Services Group at Ellin and Tucker. Hey, Todd, thanks for being on.
Hey, Kat, how are you? Nice to hear you again. And Mark, nice to hear from you too.
Thank you.
Yeah, Todd's a repeat guest. It's great to have you back on the podcast with us, Todd.
Well, thanks for having me. I'm out of Baltimore, so it's a nice day here in Baltimore and a great day to do a podcast.
It's unusual that we have all of our hosts and guests in the Maryland area, so that's kind of fun.
Yeah, that's right. We're all kind of brothers and sisters in one way or another, huh?
That's right. Well, Todd, before we dive into the topic, can you just tell us a little bit about yourself and a little bit about Ellin and Tucker?
Sure. I'll start off with our firm. It's Ellin and Tucker, and we're a Mid-Atlantic based CPA and consulting firm located here in Baltimore. And we have a very large construction practice and deal with contractors anywhere in size range from 10 million to 500 million, handle financial reporting, transaction work, specialty consulting, tax compliance, and other traditional services relative to the industry.
And what about your background, Todd?
My background is, my background's actually pretty simple. I arrived at Ellin and Tucker 36 years ago, and here I am. I got started in the construction industry, I think in around 1989, when the construction industry was going through some turmoil, and really got started in construction by dealing with some very difficult situations, and worked with many bonding companies across the country and contractors across the country that were experiencing financial distress. And from there, that kind of helped us grow and develop our practice here. And I do chair the Construction Services Group and oversee most of the services that are provided within our clientele here at the firm.
It sounds like you've seen a few economic cycles, Todd.
Yes, I have seen a few economic cycles, and I would say that this one is much different than I have ever seen before.
That's interesting. I mean, I feel like you can't turn on the news or watch television right now without hearing about rising interest rates, inflation, the GDP sagging. I mean, that's all you can hear about when you turn on the news. But that's not what you're seeing on the horizon in the construction industry space. Is that right?
Well, I'm going to comment actually on what you just said. The news can be very confusing. I know we all get our different sources of media, and you go from one news expert to another, and the opinions are just very different as to what's really happening in the economy. Can the economy go through a formal recession, which we're probably in right now? It's just the oddest recession we've ever seen. And, what is the impact? What is exactly going on? And I would say from the construction side of things, it's a tricky time for the established contractors that are out there. And I mean the ones that are the middle market and large heavyweight contractors, and that would hit all spectrums in terms of general construction and specialty subcontractors. 2021 was a very strong year. 2022 still looks like a strong year, and probably going into Q1, Q2 of 2023, we're expected to have a strong outlook on construction. So I'd say that the actual industry itself, from a backlog standpoint, is in pretty good shape right now.
Well, it seemed like there were a lot of developments that probably had an influence on what you were just saying about why it was so strong for contractors. Namely, there were some government programs that I think probably buoyed a few contractors. Could you talk a little bit about that, like the Paycheck Protection Program and what it meant to construction firms?
Sure, Mark. I think you're right as you talk about these programs that came out as a result to COVID. And the two main programs that were out there was the Payroll Protection Program and then the Employee Retention Credit Program. And both of those provided significant benefits to construction firms. Now, obviously, there were some parameters in terms of number of employees and those types of things. But in general, you saw this payroll protection plan provide a boost to the equity of these construction firms. So we looked at their financial statements. Most of them are still working because in most of the states across the United States during COVID, construction was deemed to be an essential service. So construction in and of itself was not really shut down. Now, in some localities it was, but here on the East Coast, it was definitely deemed a essential service. So it was not shut down. Companies were receiving the payroll protection loans and then benefiting from the loan relief, which helped to capitalize the balance sheet. And then the second thing, or the second program actually that came out, Mark, was the employee retention credit, which is still in process. Many companies are still applying, and I would say receiving, but the flow of funds from the employee retention credit has been very, very slow. But in each one of those cases, from a pure financial reporting standpoint and the economics, how it looks for construction firms, is another boost to the balance sheets and the equity position of companies. So even if you had a company that was experiencing some distress in 2021, there was some benefit that was derived from the PPP program and ERTC, which could have put them into a positive light. So it really did some really great things for the construction industry. And then just one caveat as it relates to the ERTC, it's actually Employee Retention Tax Credit. Okay. The main issue behind that tax credit as it relates to the construction industry and with most industries is when is the money going to start to flow in? Many of the tax returns actually related to the employee retention program have been and will be filed by paper. And so as we know, the IRS is pretty understaffed. So it's a matter of getting it to the IRS, having them file it, and then process. So we're hearing 4 to 8 months, which is pretty long. And that could be a real issue for construction firms that actually have to pay tax on that for their 2021 return, but may not receive that money until 2022 or thereafter.
Wow, very interesting. You had mentioned that this was a kind of a unique economic period, and there are multiple kind of conflicting sources of information out there. What are some of the sources of information that you look towards to really get a sense of where things are that you feel confident in? Are you looking at, for example, any leading indicators?
Well, yeah, some of the leading indicators that we'll look at are actually published through the national publications that we receive, such as ENR, which is the Engineering News Report, Construction Executive. I do a lot of research through CNN, through Fox, through other very large construction-centric consulting firms. And so I'm pulling off indicators off of that. So, for example, the most recent ENR report that just came out as it relates to construction, we have indexes that are published, which basically talk through what has happened in terms of costs that are out there. Okay. And the inflation numbers just came out, I believe, yesterday, and we're still showing pretty high inflation, 8.3, 8.5, something like that, August to August comparison. Now, I don't know about you, Mark and Kat, but I know when my wife and I go out to eat or go to the store, I don't know where 8.3% comes from. I'd actually be thrilled to death if we could see that. When you see a donut at the donut store that used to be 99 cents and it's $1.49, last time I calculated that math, that's over 50%.
Yeah.
Right. So we're seeing significant inflation. So let's talk about some of those indicators, as you mentioned, Mark. Some of the indicators in my backyard here. When we look at material costs, this is point to point. And so this would be looking at point to point, year to year, September back to September of the prior year. We have material costs up in the Baltimore area, 19.8%. 19.8%. We have skilled labor, which would be the labor out in the field, actually doing more of the skilled work, not just carrying bricks, mortar, doing things that required some specialty services, electrical, things like that, up 6.4%. We have overall building costs, which kind of combines all this together. When you blend it, 13.6%. That's in Baltimore. Let's take a look at another one that's pretty significant that just got published in September 2022's ENR report, New Orleans. I'm not sure why this is because I'm not as familiar with the construction area there. Material cost up 24.8%.
Oh,
Wow.
Skilled labor up 25.6. And then when you blend all that, the total building cost up 25.1%. So we're all seeing and feeling this. And even when you look at the boom in the construction industry, it's very difficult to tell, is revenue up as a function of more work, or is revenue up as a pure function of the cost to do work has changed the bidding price?
Yeah, great question. I know, in the surety context, obviously the prior year was a banner year. Overall premiums up above 7 billion for the industry, but you have to ask: was that as a result of overall construction costs rising and then being reflected in premiums as well? So it's kind of interesting trying to figure out whether that is because it's increased use of bonding, or it is as a result of increased construction project cost, or both. But I know sometimes people look at construction activity. And I was wondering, in that regard, are there any leading indicators that you look towards to kind of assess where construction activity is going in the near future?
And when you say indicators, Mark, can you just expand that a little bit more? Because we do look at the Bureau of Economic Statistics that are out there that kind of track GDP and things like that. But leading indicators that we really look at, maybe put out by the American Institute of Architects,
Yeah.
as I've commented on before, where we're seeing that construction spending is predicted to rise 9-10% in 2022, and also 5 to 6% in 2023. But you really said it spot on. I think the industry, the construction industry, like many other industries, is probably having a difficult time determining, here again, is this a result of new construction spend that's out there, or just increase in pricing? And so these indicators that are out there right now are a little bit misleading. And the government programs that are
Right.
out there, even outside of PPP and ERTC, infrastructure programs and things like that, that really has not kicked in yet. That really has not hit the market, meaning it's still got to trickle through Washington, D.C., and get down to the localities to start to fund projects. So we look at indicators. It definitely would be through the Bureau of Economic Statistics. It would be for
Yep.
American Institute of Architects and things of that nature.
Yeah, I think the AIA even publishes kind of some statistics dealing with design services and where they are, and if they're seeing an uptick in that as kind of a leading indicator as well. So always
Yeah,
a good place to look.
Yeah, I think that is a good place to look. And I also think that the actual surety firms, their resources and how they're looking at indicators are extremely strong for contractors to kind of tap into those resources and see if they can get a different perspective on what's being seen in their marketplace, and what the surety is seeing with other customers that may be in a similar environment.
So with this kind of uncertain climate where you have different indicators that could lead to different conclusions, what are the best ways for construction firms to really prepare themselves for the near future? Do you have any advice or suggestions on what they should be doing?
Yeah, I would say I'd probably break it down into three main segments. And prior to your question, hadn't really thought about if it was three or four or five, but let's stick to three. I'll try to just be
Yep.
central there.
sure.
One is, as it relates, let's start at the most basic. There's a concept in construction called the go or no go decision. And that decision is the decision to actually bid a project or not. And so I think the single biggest thing that a construction firm can do right now is to make sure that they are staying relatively in their lane, meaning that they're not trying to veer in a geographic location or in a niche that they're not qualified to do the work. So that's one, sticking to what you know best, and trying to operate within that segment. I'd say two is to be aggressive and proactive as it relates to your labor force. We all know what's going on in the marketplace. I mean, the reality of it is unemployment is just too low. Now, it sounds counterintuitive, but an unemployment rate of 3% or 3.5%, while it's strong, and you'd say that's a good thing, it's really not a good thing, because the economy doesn't really work very well when that's so low. So the key is to make sure that companies are paying attention to both their in-house employees, meaning their office employees, estimators, field employees, supervisors, project managers, all the folks that they employ, and be aggressive and put in proper retention strategies to keep these folks, because it's much more difficult to attract, bring in, train, and then pay. It's more expensive, much more expensive. That's
Right.
2, labor. And then third, I would say, I'm actually going to make one more. So third and 4 will probably go together. The third and fourth, we're going to combine them here, is that companies need to really look at how they're ordering materials, generic materials that they would use from job to job. And there used to be the concept in construction, it's just in time. So you order just in time for the contract. But now it's called just in case, or plan for materials early, just in case. They'll
Great term.
come out with that in our books that our kids will use in college one day. It'll be just in case. That's why I say this is a different situation. And so companies need to, when they find the low point in the pricing, if they can afford to do it, get the extra material, have it in-house, have it ready to go. Okay? And so here again, as it relates to the fourth concept, probably ties all back into the first part, is make sure that contractors have contingency lines in their bids within the realm of what the market will accept to handle price escalations and just unknowns. Just the world of construction is tricky as it is, and I feel like the contingency lines need to be a little bit more generous.
Right. Smart planning, right? And I know you had recently published a blog for us, and you talk about the importance of price escalation clauses and being thorough in contractors' contracts, that they need to really give a lot of forethought in what the risks are and planning for that in their contracts. Are you seeing that with your clients?
Yeah, we are. Now, the escalation clauses, depending on the type of contract that a construction company is involved in, can get a little bit difficult to put in place. Now, some construction firms do a better job at it than others, meaning they're able to carry their weight a little heavier, to push that clause in there, an escalation clause, but they have been difficult to get. And so for the ones that can do it, we're having them put it in there, and we're just testing the market to see if the market can handle it. But there is that balance, and it probably gets back to Mark, what you just mentioned, and Kat, perhaps what we've talked about in the past is risk reward. It's that being careful to get your arms around a job that you can understand and have some level of predictability for cost and things like that to make that decision up front.
Well, and that's a great point. And I wonder if you would elaborate a little bit more on the critical nature of having accurate work in process information and data. I imagine that's growing in importance right now in this climate.
It's been of importance forever. As I mentioned back in 1989 when I got started, I actually started my training, so to speak, in construction through the work in progress schedule. And I had no idea that the movement of a number here and there had such a dramatic impact on the work in progress schedule. And then before you know it, you look back to the balance sheet and the income statement, and the whole thing's an estimate. It's all an estimate. The balance sheet and income statement for a construction firm is an estimate, and it's really only as good as the work in progress schedule. And so, Mark, when you talk about the importance of a work in progress schedule, I think now more than ever, it's just absolutely critical. It's got to be just as critical as reconciling cash, as preparing monthly financial statements. Contractors have to understand what are the key drivers in the work in progress schedule, what are some of the risks that are in the work in progress schedule, and how accurate and reliable is that work in progress schedule.
Okay.
Key is to have it accurate, reliable, and dependable, because without that, it's not even worth the paper, so to speak, that it's printed on, or the Excel that it's worked on. And I have seen some firms do it much better than others. Mark, we could probably tell war stories about the ones that do a great job at it and the ones that just do not do a good job at it. And I would say that the ones who don't, they need to start doing a much better job, or they may not be here.
Yeah, absolutely. And in terms of the surety professionals, are they reinforcing this point with their clients?
I think they've always reinforced that point. In the surety, unlike a bank, a surety is so experienced in looking at a work in progress schedule. I spend a lot of time training banks across the country and understanding financial statements for construction firms. One of the big things we talk about is the work in progress schedule and how you evaluate its accuracy, how you look for profit fade or profit gain. And they have a more challenging time to do that, but now they're getting better equipped because they have perhaps people like myself educating them on how to do that. The surety's been doing this for a long time. So they've been preaching this to construction firms, and they've really been challenging them when they see material changes in work in progress schedules. So Mark and Kat, I would say that the surety is all over this now more than ever, especially as it relates to construction costs, the uncertainty that's out there. They are really challenging these. And I would say to the construction companies that are listening to this podcast, sureties that are evaluating your work in progress schedules, they are skilled. If you're not telling the truth and putting the proper numbers down and evaluating what's really happening, they will. And you should be prepared for some difficult questions. So why not do it correct from the start?
Right. Well, you raised lenders, and they're certainly an important constituency, and that I may take you on a little bit of a tangent here, but I think as an industry that's serving the construction, it seems so important to educate lenders, not only on financial statements, but also the uniqueness that is construction business cycle. And then I imagine accounting changes that are going to be impacting that. So could you talk a little bit about the lease accounting standards that are coming out and what that might mean from the standpoint of the education that needs to be done?
Mark and Kat, I think that the lease standard that we're talking about here, while it's been implemented and out there for publicly traded companies for the past couple of years, the accounting world tried to bring this out for private companies. I believe I did a conference where I was a speaker on this topic about 4 years ago in Phoenix, Arizona at the National CFMA conference. And one of the things that I talked about at that conference is I didn't think the standard would actually come into play for private companies, for private, non-publicly traded companies. And I'm not much of a gambler. Perhaps I should have gambled a little bit because it took 4 or 5 years now for it to actually get implemented. So it'll be implemented in 2022.
Yep. Right.
And when you say, what would that impact be? I really don't know if it's going to be much of an impact other than it will create leveraging on the financial statements of construction firms. So at a very generic level, right now, capital leases, which are more buy type leases, they kind of operate like debt. They're recorded on the balance sheet. You record the debt, you record the asset. The new standard codification standard that is going to come into play for year ends December 31st, 2022, you could have adopted it earlier, but for 2022, it's mandatory, is where operating leases now will come onto the balance sheet. So for construction firms that have construction equipment that they hold under an operating lease, buildings, et cetera, you will record a liability and an asset. Okay? And so when a bank then looks at this, they need to understand that will change certain ratios, the debt to equity ratio, and things of that nature. Where I really don't see much of an issue is this isn't what's called funded debt, which means it's not like real debt where someone has made the loan of the green stuff, the green paper for the contractor. So I think banks will actually have a pretty good understanding. And here again, our firm is educating banks as to how to look at this, how it gets implemented, and also the surety firms too, Mark. We're working with them to educate them. But the bonding companies don't really like this standard because it throws off their old way of doing the math. I mean, think about it for a sec. SOP 81-1 was back from 1981, and that's basically the construction accounting rules. Really not that much has changed. Now, the revenue recognition standards changed, and there's some nuances to it, but it's basically the same. It's so archaic how this industry has been set up over the years that the spreadsheets and how they monitor accounts, they don't want this change. They don't really like the change. They can see it in the footnotes of the financial statement. Is it out there? Is it going to hit? Yes. Do I think from a banking standpoint, it's going to impact how a bank will lend to a construction firm? I would say no. No. And that's not what we're hearing. Banks are having to amend their loan documents actually for two things. One, the new lease standard, and two, the fact that banks will be moving away from LIBOR lending to what's called SOFR lending. And that's just a different interest rate category.
Oh, okay.
Interesting. Well, I think it's important to contextualize it. I certainly appreciate your thoughts that it is going to get accepted and people get comfortable with it, and then they'll know how to look at things the right way so it won't disadvantage contractors in the end.
Yeah, I don't think it's going to disadvantage them at all, Mark. I think that it will just be a somewhat non-issue. It'll be a big issue for 2022 because there's a little bit more work that needs to get done, but it'll actually be a non-issue as it relates to the go forward and underwriting and things like that.
So I know, you still hear some talk out there by pundits about possible, backsliding into a recession and so forth. Are there other bits of advice that you would provide construction companies? And then also, what advice would you give to the surety professionals attending them?
Well, the advice I would give to the construction companies, and I'm going to backtrack slightly, Mark, I don't know if we're in a recession or not. It would be the oddest recession we've ever seen. I would bet you by pure economic standards, the actual calculation of what it means to be in a recession, we may actually calculate that we're in a recession. But here's the odd part. Profits are up. Employment levels are through the roof. And other factors conflict that. So that's why I started off our podcast saying this is a pretty odd situation that we're in.
Yeah.
So the advice that I would give to a construction company is to make sure a few things. Is to make sure that you have your financial house in order in terms of making sure that your lines of credit are properly in place. And if you can, try to get a 2-year line of credit agreement instead of a 1-year line of credit, that you have enough dry powder within the line of credit agreement to handle the growth that's happening. My rule of thumb, I like to have clients have lines of credit about 10% of their annual revenue. Very simple math. You have a $100 million contractor. You should have a line minimum available of $10 million. So make sure that you have proper lines available and capital available. Make sure your financial reporting is in place. And make sure you're doing everything you can to retain your critical employees. And from that, that's your best shot at trying to make it through if a storm does come through. But remember, the construction cycle is different. The construction cycle is always about 18 to 24 months behind the rest of the economy. So if we do get hit with a more formal recession that would be more generic to the economy, it still could take 1.5 to 2 years for the construction world to catch up and feel that pain. And so that's the advice for the construction firms. I think from a surety standpoint, Mark, sureties just need to be on top of these accounts. They cannot get comfortable that just because you have a strong 2021 or strong 2022 that everything's okay. They need to make sure they understand when they're doing the underwriting, what is the quality of the backlog that we're looking at here? Are there hot spots in the backlog that everyone needs to be aware of? Is the construction company financially sound? You need to make, it's kind of like the go, no-go decision. It's the same thing for the surety. Make sure from a surety perspective, you're working with clients that you're comfortable with and customers that you're comfortable with. The problem with that right now is the surety industry's made a lot of money, which means they have a lot of capital to put back on the street. So that might conflict too. So they may be taking some more, I don't want to use the term flyers too loosely, but some flyers here and there and giving a little bit more bandwidth out there in the industry. So we may see some greater losses. I mean, this past year was a very good year, but we may see something change down the road.
Well, that's great, Todd. It's been good talking with you. It is, like you said, just really weird economic times. And it's good to talk with someone who's got your insight and background just about how you're seeing that in financial statements reflected for contractors.
Well, thank you, Kat. And Mark, I thought your questions were kind of spot on. So I appreciate you kind of really honing in on these key issues that are out there in the construction industry. Because I would say for the listeners of your show, we've really touched most of the main high-level key points that need to be addressed. really nicely done.
Excellent. Thanks, Todd.
Yeah, hopefully we'll be able to have you back again.
I hope so. Thank you, Kat, and thank you, Mark.
You've been listening to Let's Get Surety. Let me hear your bonding talk. Brought to you by the National Association of Surety Bond Producers. For more information about the NASBP and its members, visit nasbp.org.